All right, stocks continue to decline and really show some kind of like final things. Like there's been this kind of growing list of all these factors that distinguish a pullback that will bounce up to new highs versus a pullback that will bounce up to a failed high, lower high point, and then move into correction mode. Right, so there's kind of a lot of factors that distinguish one from the other, and that list has been growing. We've been getting more and more and more of them over the past couple of weeks. It seems like today we kind of pretty much got all of them, all the rest of them that we hadn't had yet. Including the actual 10% drop from close to close in that red box, which a lot of people kind of look for and very well could spark the rally, right? The bounce off the lows. I don't think so yet, and we'll talk about that more in the video, but I'll break down what those last remaining signs were. Again, those signs that every pullback has that ultimately has led to a correction that all the other garden variety pullbacks don't have that end up bouncing up to new highs immediately, right? So we'll break all that down. We'll take a look. Gold's really moving higher today. We'll talk about that and a lot of other moves in some of these different asset classes and kind of we'll talk about something that we're missing. There's something that we're missing here that gold might be actually taking the place of. So we'll spend some time on that, and then our trade idea. A trade idea is a trade on a stock you all know, but we'll talk about how to trade it, knowing that there will be a short-term bounce here. That most likely will fail, and there will be a move later that will ultimately get to lower lows. So how do we trade both of those like today? So we'll talk about that with our trade idea. So let's go ahead and get started. Today is Thursday, March the 13th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website on MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live videos where I take a look at old Market Outlook trades, see whether we should stay in them or get out of them or not. We also put on today's trade already before the market closed here. Come down to the bottom, click this heart, it opens up this tab, hit that like button, same thing here, click this thumbs up icon, it opens up this tab, hit that like button down there. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you again for those who do that day in, day out. Those who don't, you can do it right now. Help us get up to our goal of 50 likes, right? We've done it once here recently, let's see if we can do it again. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. So again, another down day. We avoided a cluster. We were right on the cusp of a cluster at the lows of the day today. We did avoid that. I tweeted out about that earlier. I also tweeted out about being 7% below the moving average, which we did finish below 7% mark again. This first line's 5%. It's kind of a standard number, but that second mark is a 7% mark. And just to kind of give you an idea of when we tend to get below at least get to that 7% mark below the moving average. Again, the last time we did was during the 2022 correction, not any time between. Before that was 2020. Again, no other time between during all those normal. These are our corrections here. 2018, a couple of times. Again, no time between at the beginning and the end of that correction. 2018, we got there at the very beginning of that big drop. And that's what I think that's probably our best case scenario is that this drop is similar to the early 2018 drop, where it looked like we were on the verge of a correction, and we ended up with just a pullback because we never did drop below the 200-day moving average, which is crazy. We had a 10% drop. If you see right there, see a big 10% drop, and we actually failed. We just never got to lower lows, which is, that correction is you get below the 200-day moving average. If you go back here to that time frame, to early 2018, because we were so far above the moving average, and we had the drop, we had the failure here in early 2018, and then the second drop again didn't get to lower lows and got to the 200-day moving average. So remember, a correction is an extended period below that. So So, 10% drop and a 7% rally, but we never really, we never really broke. I think that's kind of the hope here. And now, granted, we have broken the 200-day moving average, so it's a little different in that regard. But I think, here we are at 10% with at least close to a 10%. I think we finished just under the 10% mark. No, we did. We finished over at 10.13, right on the 23% retracement of this from the last correction low to the current high, recent high of that move. You can see the last time we had a correction in 2018. We did not get to the 23%. We eventually got to the 23% retracement and had that 11% rally. This was the failed. This was our original failed bounce, but this was kind of a secondary one before we finally really broke to lower lows and got down to the 38. So, we've already gotten there. The 23% retracement, 10% decline. I mean, those are significant moves, again, that don't typically happen during your garden variety pullbacks here. Short-term sentiment is still bearish, and that's the thing. We still haven't had a near-term line jump up about 50. Usually during these pullbacks, we'll have at least one, maybe two near-term rallies into bullish territory, but then they fail to get above 80. We haven't even. I mean, we've only spent like 1 day out of bearish territory. It's been a pretty significant move to the downside here. If you look at the Nasdaq 100, also avoided a cluster. Again, we're at the 8.8%. We're very low. Dark pink shading and a red line near term. I mean, it looks exactly the same as the S&P, except for market sentiment is in the lower half of the chart, and it's really close to now getting the bearish territory. The Dow Jones Industrial Average did get a third cluster in a row, so 3 days in a row of a cluster. The near-term line still in the oversold levels. Now barely, but still all 3 days below 20. The momentum line is the worst out of the 3 days today. And then finally your Russell 2000. It's been, like I told you before, it's in correction. So it has moved to the 200-day moving average. It has failed at the 30, 50-day moving average, and it has broken to lower lows. I mean, and it's broken the 200-day. We're below it. Like, that's correction. That the Russell 2000, it went into correction at the end of 2021. The S&P was not yet. So it preceded the S&P by a few months, a month or two. And it appears to be doing the same thing right now. That's, again, why I think that the S&P is likely to go into correction mode here, because the Russell 2000 already is in a correction mode now, and it's probably going to bring that. I mean, we're 9% below the moving average there. That's a significant level for the S&P 5 or for the Russell 2000. Let's take a look at the weekly chart. As you can see on the weekly chart, we have closed below the 40-week. So far, we got one more day left. We closed below the 40-week exponential. On the Hakinyashi close, we have, we're moving towards zero on the long-term PPO. We have a lower low, a lower close. A significantly large candle here. When you look at the size of this candle, again, it's pretty darn big. We don't generally get this big during just garden variety pullback. So it's a big bearish candle. It's below the 40-week exponential. Again, it's all pointing to that after we get a bounce, because we will get a bounce. Like every correction has a pullback. So we will get a bounce, right? The question will be whether it will fail or not when we do get that bounce. And it will be fast, will be really quick. We'll get to 5% very, very quickly. Then the question will be whether it fails, and that will take some time to figure out that failure. But it's looking likely that we will ultimately fail when we get to that point. If I take a look here at the 3 green arrow chart, you'll notice that we have 3 green arrows across the board. 3 red arrows, across the board still. I mean, it's like day after day after day here, full on bearishness. I mean, it's one thing, like, just to kind of give you an idea of what these look like, the intermediate declines, like the last few, I mean, it wasn't day after day after day right there. And then the time before that, again, same thing. Like, we have near-term rallies, like where we don't have 3 red arrows. Same thing here, it didn't last that long. You can see, lasted a little bit here before we got it's like what, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days. And then we got out of it, and same thing there on that pullback. But we can see like over here, 1, 2, 3, 4, 5, 6, 8, 9, 10 days before we pulled out of it with that explosive 5% rally there. We are now at, what would this be? Well, stochastics was our last one. So 1, 2, 3, 4, 5, 6, 7, 9, 10, 11, 12, 13, 14 days of 3 red arrows without, and it doesn't look like we're going to get a green. I mean, the MACD is way down. The stochastics is way down below 25. We're way below the moving average. Like, I don't know when the last time we've had this many days in a row, especially coming off of a high. Like, it's one thing, like, if you're in correction mode, I mean, you probably have to go back to COVID to see something as big with the 3 green arrows there. Let's see, this is COVID right here, and I don't even know if COVID had it. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 12 days, and we're back to it. So yeah, this is a significant amount of time. There was a couple of days here in between where we didn't have it. This is a significant amount of time that we've been just straight 3 red arrows, day after day after day after day, and it's not ending anytime soon. Now, I take that back. It can change soon when we get these explosive moves to the upside. That doesn't necessarily mean that we'll get 3 greens, but at least we'll get maybe 1 green on the stochastics. So it can change, but it won't change barring those big moves to the upside that, again, could start tomorrow. Probably won't, because Fridays haven't been a good day for the markets here lately. But most likely next week, we'll start to see a significant rebound off of what has been a really bearish couple of weeks here for the S&P 500. All right, let's see here. Sorry, messing with my camera again. Let's take a look at the 2-line version of this chart. And you can see, again, below the 200-day moving average, the MACD has hit 2. So, again, you can see that number right here. So it tells you the current level of the light blue line. That's 2. So again, we don't get to 2 during typical pullbacks. Even over here in August, we didn't, with that crazy day we had, we didn't get to 2 on the MACD. This is some bearish momentum that we generally see during the initial stages of a correction, right? Even though a lot of people say, oh, the S&P, you'll hear this a lot. The S&P hit correction territory today. No, that's not how this works, right? There is no correction territory is an extended run below the 200-day moving average. It hit the 200-day moving average, went a little bit below it, but we still need to see the bounce first before we enter correction territory, because there's always a green tag. Remember, there's always a green tag that comes after a red tag. Always, always, always. So every pullback, even if it's a 10% or 9%, remember, even COVID, there was a green tag after the initial pullback, right? The initial pullback was 12%. There was a green tag, and we had 6% gain, and then we fell down to correction levels in that case. So that we're going to get a green tag here, and then if and when we fail, which I think is most likely now, considering again like some of these signs, like this MACD being so low, when we fail, and it still isn't if, because nothing's 100%, but most likely when we fail, then we'll be in correction territory. Then you'll break the 200-day again the second time, and then that's correction. Because remember, correction is an extended run below the 200-day moving average. It doesn't matter what percentage the decline was, right? It's just an extended run below the 200. It's a move to the 200-day moving average, a bounce that fails, and then an extended run below it. That's what a correction is. If I take a look at the let's take a look at some of these other oscillators. Let's do this DMI like we always do first here. So the DMI, again, look at that ADX is spiking up to 34 now, really moving higher. We're still above 30 on the negative indicator, not much below 30, but the positive indicator is just plummeting. Like it's almost below 5. It's there at 6.5. So big drop there, but that's a big change. And this is such a huge change to go from below 10, which is rare enough as it is. But then the jump above to essentially to 35, just in a matter of a few weeks, that is uncommon. Even for corrections, that is uncommon how swift this move has been. In fact, Brandon tweeted out about this. So we've been, this has been a 16-day rally, right? So let's change the rate of change here to 16 days. That this is like, this is a pretty fast move to get to a 10% decline during a 16-day window, right? Because that's what we've been. This has been a 16-day drop. So you can see it's not the first time, though. Look at 2022. We had multiple 10% declines over 16 days. 2020, we had obviously COVID. 2018, we had a 10% decline, more than a 10%, over 16 days. 15 and 16, we had a 10% decline at the start over 16 days. 2011, 2010. These are all corrections. So every correction, there's a lot of commonalities among all these corrections, and they're just piling up, right? And here's another one, a 10% drop in a short amount of time, in this case 16 days, that fits every other single correction that we've ever had, including, for that matter, the 2007-8 correction that turned into the bear market, right? There's the bear market, the correction failure, and then the move to and through. Those are all the stages I outlined in my tweet I have there. So even that one had a 10% decline over a 16-day window during the initial stages of that bear market. So we're seeing it again now. Let's take a look at the RSI and the CCI. Of course, they're still at bearish levels. The RSI is below 30. So this is not going to last. We're going to explode higher. I don't think it will be tomorrow. It could be. I don't think it will be tomorrow yet. But there's a good chance it could be tomorrow. I definitely think by next Friday's options expiration close, we will at least be on our way to that 5. I think we'll actually have it by next Friday, that 5% tag there. I think we're going to get big. We just need that VIX to get bigger moves. We'll look at that here in just a second. If I take a look at the Bollinger Bands, let's look at the Ichimoku cloud, way below the cloud. So again, we don't get below the clouds and stay below it during pullbacks. We do during corrections, a very significant rate of change. Mature trend, which again we don't get during pullbacks, but we do during corrections. Mature bearish trend. Let's look at the Bollinger Bands and the Keltner channels. We are still in the lowest quartile. The bandwidth has exploded higher, just absolutely exploded to the upside after being so extremely low, like that ADX, so extremely low, just a big time explosion to the upside. So again, the last time that we had an explosion this size on a bearish move was early 2022, and you can see obviously COVID and 2018. You can see where my cursor is here. This is the early stages. The first pullback stage of the 2018 correction was, we're higher than that now. So, we are definitely, again, not your garden variety pullback, that's for sure. So, which means is we're probably not going to get back to new highs within weeks. The next pullback, the next bounce, most likely won't get to new highs. That's what that means. There still will be a bounce. So, and we should expect it to get higher. But once we notice it failing at resistance, at moving averages, Fibonacci resistance, whatever, then we say, okay, now we're going to most likely go to lower lows and spend an extended period below the 200-day moving average, which means we won't get back to new highs, in this case all-time highs, for months, right? That's how corrections end up working. The difference between pullbacks and corrections there. If we take a look at the intraday chart, again, lower high, lower low. We closed below yesterday's low. We made a run to get above yesterday's low. We didn't hold it, but we didn't go very much further below it. Closed lower to the low. Again, another low point. This is a lot of new lows. Look, we haven't gotten a lot of new lows in a long time. Again, if I zoom out here so we can see when that red line has stayed near 100 for so long. Again, you can see these kind of pullbacks. There was a period of time there. Some pretty long periods there. Remember, this is, really 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 days that we've only had 1, 2, 3 days without a new low. So 10 out of 13 days, you're kind of looking at around this stage here, and when we were already in correction. Here was a stage that we went through with a lot of new lows, but we had some periods without new lows there. Even that initial stage in 20, you have to kind of go back to COVID level to get, and we had that period there, that bounce without new lows, but we had a lot of new lows back to back to back. So needless to say, like this has been kind of an extent. I mean, we're above 10% now in the 4-week range. We got a lot of new lows. The red line's moving towards zero. This has been a significant move, to say the least, here. Obviously, the volume and the trading ranges continue to be large. The trading range is actually a little bit below the average. Sorry, wrong one. Let's go here. The trading range ended up being a little bit below average. The volume ended up being a little bit above average. These two lines appear to have potentially be peaking. But remember, this won't peak until after the bounce, because remember, the first 2-3 days of the bounce will be huge moves, bigger than average moves, which will make this probably get up above 2, which again, 2% is a correction level increase in the normalized ATR. So that kind of, again, goes to show another commonality that we can check off the list for this pullback, right? Because it's, the question is, will the pullback lead to a correction? And the answer is getting more and more as to yes, because of all these signs that we're seeing here. The one sign that we're just not seeing is the jump in the VIX. The VIX was only up less than 2%. The market was, let's see, how much was the market down today? 1 1/3%. And the VIX had one of its smallest gains to the upside during this whole rally. In fact, so we started on the 20th. That was higher, that was higher, that was higher, and that was higher. So this is the smallest gain in the VIX on any day, that we've had, even though we had another 1% decline, right? We've had lots of 1% declines, but not very many where the VIX didn't go up more than 2% in that day. So it's a fascinating move on the volatility index. So we're which suggests that we just can't get that exhaustion breakout move up to 115 or whatever, and just finish this. You can see the VVIX is still above 110. So we're still actually kind of poised for that kind of move, even if the last couple of days, we didn't fall today, but we're off the highs of volatility that we had from a few days ago. We went down 2 days. So we might have peaked. I still think we probably have maybe one more day up to the 30s, because now a 20% gain in the volatility index will get you basically right to 30, without necessarily getting above it. And that's the kind of move that I expect will ultimately kind of wash out the volatility and finish up this decline and set it the stage. And it could be tomorrow, because again, markets aren't very good on Fridays these days, this calendar year at least. So it very well could be tomorrow that gives us that washout move. Maybe a move down to 12% on this, because remember the COVID drop got down to 12%. So maybe a move down to 12% and we wash out. Maybe it's an intraday bounce, right? Maybe we get the bounce on an intraday basis tomorrow and we close up higher. But I would still be kind of watching for a washout move to the downside with the associated washout and volatility, before we get that explosive rally up to that 5% tag or more. All right, now let's talk about how things are moving today in the other asset classes. Of course, look at that move on gold. Gold is spiking, which might be kind of the equivalent of the VIX washing out, right? To see gold moving up as much as it has been the last couple of days. Here is the today alone. This is with the dollar up today too, marginally, but the dollar was up today. Gold is really blowing out here. In fact, if you look at its DMI pattern here, and we'll look at the ETF. Well, let's look at the futures contract, because the futures contract doesn't have the gaps like the ETF does. Look at that blowout again. We were parabolic here. And then now we're up to new highs. We're coming off the lows. We're above 25 on the positive indicator, back below 20 on the negative. The ADX is rising again. We're just moving up just like that. So things moving pretty quickly on these safe haven trades. IWM getting hammered, which, remember, that's the kind of the key here when you look at the ratio chart of the Qs to IWM. So let's go to the ratio chart. That's what's keeping this afloat, right? This is I mean, we're still like below the 17-day moving average, and we haven't really broken down on the long-term average here, even though we're kind of converging. But we still haven't really broken down here. And when we break down, like when the Qs breaks down, because XLK definitely has broken down. I mean, I know it had a good day yesterday, and we were kind of happy about that. But the reality is, like, it's still like below the 200-day moving average. It's back below its short-term averages. It's still bearish here. This is like the Qs are still holding up pretty well against small caps, despite the fact that the big dog is definitely rotating out of favor. Here's your daily charts now. Some of these safety trades are starting to roll out of favor as well. Healthcare, I mean, they're still in the leading category. They're just moving down. They're losing momentum, but you're still not gaining a whole lot of momentum in either. In fact, XLC is actually still moving lower. Well, actually, it's up higher, but it's still down in the weakening category. Neither one of these three are really taking off to the upside on the daily version. And remember, the weekly version, I mean, they're exploding to the upside, a lot of these safety trades. So it might be kind of a short-term rotation to weakness, but probably won't be enough to halt this. That's a strong momentum up to the upside there in terms of sector rotation. We did get a little bit, because of the weakness in the Russell 2000 lately, the breadth is starting to deteriorate a little bit. Like, we're back below minus 58. We're well below zero here. So this is a pretty steep decline. Again, remember, we're not coming from high level. So we're coming from a weak level, which, again, sets us up for correction when you get, lower highs like this associated with higher highs on the index. So, but it's looking poor. The money flow, I told you, has also really picked up to the downside. The oscillator got down below 30 briefly, and it's continuing to move lower there. When you look at some of these other breadth indicators, the number of stocks above the 200-day moving average here has plummeted. It's down below 180. It's well below 200, which is 40%. I mean, that's 50% is a key level, but this is a steep drop in the number of stocks below the 200. The number of stocks below the 50 is also down, well below 200, steep in bearish territory there. So that's why you don't really have, that's why it's like, we're not really spiking here. Like, we spike whenever they're just typical pullbacks, but that's mainly because most of the stocks stay above their 200-day moving average, even though they drop below the 50. So this really jumps because of that. But in this case, we're dropping below the 200 and the 50. And again, we saw that. We have seen this before. The last time we saw this was early 2022, right there, right here. When we got to these lows, that first pullback low right there, you can see where right there is the peak of that ratio chart, and it's about the same as what we're seeing right now. And the next leg lower, it was even a lower peak. And again, the reason being is we have so many stocks breaking their 200-day moving average that it's hard for this to really blow out to the upside to signal a low point. So if I zoom out here so we can see that early 2022 drop, like right there, you can see we dropped below 250 as well on that first leg lower, and then the second leg lower, we got all the way down below 200 like where we're at now. That's what's limiting that ratio from taking off, and again, I think limiting the ability for us to get a low point here and take off. You can see the number of new lows. Let's see where we end up. Let's see if that's updated, because this updates automatically. 183 new lows, so it's actually not updated. So right now it's at 159. We're actually right here, 183 new lows. So I mean, the average is almost above the 4% mark. Remember, I told you the 4% mark is either we get there and we're done with the pullback, or we get there and we stay there so long that we're in correction, like 2022. And now the average itself, after kind of a brief, in fact, if you go back here, the average, the 20-day average, also at the end of 2021, briefly got above the 4% mark before pulling back, kind of like we did here, and then it stayed up for good in 2022, and that's what it looks like it's doing now. Like, we have so many days, we stack these days of high lows that the average just stays above. In fact, it stayed above the 4% mark all the way through the correction until July, and then we got the Jackson Hole smackdown. Right, and then we went back above it before we finally got below the 4% mark there, and we're good. Remember, it looked like the Fed was like, hey, we're going to do whatever it takes, and then Powell came out at Jackson Hole and said, no, we're not, because we're more worried about inflation. And so we got that leg lower to the downside. So getting the average above 2% or 4%, excuse me, is a significant deal. And it just tells us again that the net new highs and new lows, the average here is now down below 200. Again, not something you typically see during pullbacks, right? To see the average net new highs and lows get so low on a negative level. Let's go to remember yesterday I showed you the sector rotation. I said, hey, the reason why I wasn't so gung-ho that yesterday was like the first day of this blowout move to the upside, because I thought it was just a oversold bounce off of an extreme lows, especially for XLK and XLC and these others rolling over. Well, that continues to be the case. They're still the biggest performers. XLV, XLP, XLRE, XLU, all your safety trades are only down, 1 3/4 to 3%, 3.5%. That's not bad, but these two are still down near their lows. 15 near 15% there. That's not, again, not a good sign. But again, when we do get our bounce, look how much of a gap there is between the S&P, and these are the only two sectors underperforming the S&P. So those two will explode those two in particular. But as I said before, there is a long way that XLK has to go to get back to like the point of control. These intermediate term moving averages, which will probably be sitting at the 200-day, maybe a little bit below it by the time we get there. Like, that's a big move to get to that point. Just to get to that point, right? It's going to take a really, really big move just to get to that point, but it's got to blow through that, and that's a heavy resistance that it has to blow through. And there's only one volume node left. You break this volume node, then it's free sailing down to this 172.88, pretty much the pre-2022 high point at that point. That's what corrections look like, right? Failing at those levels, and then working our way down, in this case, back to the 200-week moving average, which is going to be some very significant support. Even though there's significant resistance on the daily chart, there's not very much support until you get down to this strong level down here. So very well could be what leads us both to the upside into the short term and to the downside here in the long term. And that actually brings us to our trade idea of the day, which is on Apple. Apple's our trade I want to take a look at. Obviously, Apple is in a bearish mode like everything else right now with the markets, right? You have dark pink shading and a red line. Came that close, 0.469 close to a cluster. We're the lowest below the moving average that we've been. You take a look at kind of a long-term view for Apple, and you can see a big bearish candle here. Clearly things have changed. This doesn't look like, for Apple even, that it's just a garden variety pullback. We're below the 200-day. Look at that big old resistance that we have up there. The point of control at its 200-day moving average. That MACD is down well below 2. Remember, this is an apples to apples, so looking at 2 is the same on SPY as it is an Apple, even though the prices might be different because it's normalized. PPO is a MACD that's normalized. If I take a look at some of these other oscillators like the DMI, you can see that we are pretty strongly bearish there, almost at 40 on the negative indicator. We got there over here and actually did get a cluster over there when it jumped up. So kind of similar level, of the ADX was higher there than it is now. The RSI and the CCI are down at extreme lows, well below 30 on the RSI. We got below minus 200 on the CCI. The Ichimoku cloud is also, we're well below the cloud kind of correction level. The cloud's been pink for a long time. The rate of change is significantly bearish. We don't have a mature trend yet, but we're very close because we're almost below minus 5, which is the qualifier there. So you can pretty much say we are. And then finally, when you look at the Bollinger Bands and the Keltner channels, its bandwidth is pretty high. Again, we've been below the lower bands for multiple days in a row, and below the lower Keltner channel with a big spike in volume. So it's pretty extreme. So in the short term, what I decided to do here was to do a bull put spread for April expiration. Again, which means I don't have to hold it all the way to April expiration. I can get out of this as soon as I get 50% of the maximum gain. And we did this trade. During the Market Outlook Live. So trying to make $500 for $1,000 of risk. Once we get to 250, we'll take the gain, right? Whenever that occurs. So if we get that big bounce up in the short term, that's kind of the idea behind that trade. But I think that Apple is probably going to make it down to the 200-week moving average, like XOK and the S&P. I think we're in correction mode. So after we fail, we bounce up towards resistance and fail, we most likely will move back lower and go lower for a while. So I went out to do a long put then. That gives me a lot more time to work with. Through April expiration all the way to May expiration. It's a long put. I went to the 40 delta, which because it's cheaper than going at the money, where I put a 50% stop order, because it's cheaper there, I can go without a stop order. So that, generally speaking, we put a 50% stop order at the money. We put a 30% stop order if I go to the 70 delta. The price, the contract that's closest to the 70 delta, we use a 30% stop. That's if you have a pretty good trend already established. Or I go to the low 40 delta if I don't want to use a stop. That way I have a lot of flexibility. We can bounce up. I don't have to worry about being stopped out on that short-term bounce to the upside. But ultimately when it rolls over and bounces down, then that's how this tries. And if it doesn't bounce up in the short term and we keep going down, then this will make a lot more money than what I lose on that bull put spread, and I can close that out and let this go, and then that delta will eventually grow. I'll make more and more money. But I don't think that that's going to be the case. I think we'll bounce up in the short term, and not having a stop order will allow me a lot of flexibility so I don't get stopped out prematurely. And then when we roll back over and move much lower, I expect that this would mean, like right now, by May expiration, just to kind of give you an idea here, let me get rid of the April contract and we'll look at May expiration. Like right now, one standard deviation move to the downside is down here to 180. Just kind of show you where the support is at the 200-day moving average is right around 180. So if we get down to that spot, and I'll get out if we bounce, if we take off and we don't fail at the moving average, we just keep going higher, then I'll get out of this contract when I've lost 50%. So it's about my typical $450 of risk. But with a potential $1,500 reward if it hits my target, we'll take that reward risk ratio any time of day, especially if I can get a good gain on that short put vertical, the bull put vertical in the short term when we bounce up in the short term. And so that will help offset any unrealized losses I have on the long put. And then when we fail, I close out the short put, or I take my 50% maximum gain, and then I let the long put do its business. Let it work. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us on MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Thursday night, everybody, and we'll see you all tomorrow.